Okay. The homework 11 is just all about inflation, and we're going to talk more about that today and do a couple more example problems. And time's continuing to march on with the project. Just got a question about the write-up for part 5, and I don't have a specific page count in mind, but the point is with that write-up is that every one of you is going to have some pretty personalized and hopefully detailed assumptions having to do with your expense, your income, how you prefer to save over time, what you anticipate your charitable contributions to be. So if you just kind of walk me through what are some of the data sources that you consulted. For instance, how did you determine your expenses? I'll be relatively unimpressed by people who just like pick a number out of thin air and say, well, I'm going to budget $750 for rent. Like that, if that has no basis, then that obviously isn't the same level of effort and polish as somebody who actually is thinking, all right, well, I want to live in Columbus and I want a 2-bedroom apartment. Here's a listing of a 2-bedroom apartment in Columbus and it's $1,100 per month. If you put maybe just a little bit more effort into it than picking a number that you're going to use as a budget. If your cost estimation for your living expenses has an actual basis, and in the write-up you explain to me the data sources you've consulted. Same thing with the salary that you hope to earn after you graduate. If you just say, well, I talked to someone and they make $70,000 per year. That's okay. It's better than nothing, but I think that there are a variety of sources online where you can get, for the specific career that you have in mind and the location that you've got in mind, you can find either job openings or salary data that's maybe just a little bit more detailed than one person you talk to. So part 5 should just be a write-up that explains what you did and what you're assuming, because there's going to be a lot of numbers there that themselves maybe don't tell the whole story.
Can we do something like VA has a 0% interest rate, right? Can we do something involving that and then like put a house listing that we put into like we average put away for maintenance costs and stuff?
Okay, so we're going to continue talking about inflation today, and I thought it'd be interesting to look at a little bit more statistical data. And this is a figure that I found from the Federal Reserve Bank. This is the St. Louis Federal Reserve. And there are several different satellite offices in various cities across the country, and my understanding is that each one of them focuses on gathering slightly different data. And so this unemployment data is on the St. Louis Fed website. And what's shaded in the gray here is periods of economic recession. And the line is unemployment rate. So what you'll see, this goes back about as far as 2000. There was this shaded period back in 2001. And does anybody know the history or the background or maybe even just what this economic recession is called?
Dot-com bubble burst?
It's the dot-com bubble burst. That's right. It's throughout the late 90s and 2000, people were really excited about the internet. It was just when you started to be able to shop online, and so there's just a litany of famous failures of stores that maybe weren't economically viable. They got a bunch of investors' money. They had low prices, but it wasn't sustainable. They didn't escape the drag of their costs, and so they didn't get profitable. And suddenly, kind of all at once, people realized that technology stocks and internet-related stocks were overvalued, and so finally people recognized that, and it caused an economic recession. And what you'll notice is that there was a big increase in unemployment during that period, where previously it had been maybe as low as about 4%. It ended up well above 6%. And as we're going to see on the next slide, one of the few tools that are available in situations like this is the interest rate that the Federal Reserve Bank charges for short-term loans of money. And so what they can do is they can put money in and take money out of the economic system by relatively raising and decreasing the interest rates that they charge. And by doing that, they can stimulate investment, or they can make it more expensive to borrow money and slow down the rate of economic growth if what they view as the economy is overheated or entering a bubble. So an economic bubble is when maybe an asset class is overvalued relative to its actual underlying value, where people are just excited about some new technology, and so they're bidding up the price of the stocks, and maybe there isn't the same underlying profits that would justify the high prices for those stocks. So this was the dot-com bubble with internet stocks. Does anybody remember or know what period of economic crisis this was? Housing crash, exactly. And this was a much more painful one than the internet bubble. The housing crash, if you'll remember, basically during a period of really relaxed lending standards, people were getting loans for big houses when they didn't necessarily have the incomes that would justify those loans. They had, a lot of banks did, or loan originators had what were called liar loans, where you didn't actually have to prove your income. You just had to tell them what your income was, and then no evidence was required. So, you know, a college student who had just graduated from school and maybe even hadn't even found a job yet would go to a bank and take out a loan, buy a big house. And what happened was eventually enough of those loans started to fail that the banks that had originated those loans were starting to come under a little bit of pressure, but maybe even more significantly, there were investment products, credit default swaps, and derivatives that were based on the strength of mortgage-backed securities. And so people weren't paying their loans, and it caused a big economic meltdown, and there was a huge increase in the unemployment rate, which hit about 10%. And the area under the curve is really the true story of the misery, because it's not just about how high the unemployment rate gets, but it's how long does it persist. And so what you can think of is that a lot of people consider 5% to be full employment. You'll never get down to 0% unemployment, because there will always be certain people who are maybe going through retraining, or there will be people who are in the process of changing jobs, or maybe they're just terrible employees and they shouldn't be employed. So people seem to agree that what's stable and sustainable and full employment is between 4 and 5%. So anything above that we can think of as economic pain. People who want to work and are qualified to work and under ordinary circumstances would be working, but for whatever reason the economy isn't able to accommodate their work. There's just not enough jobs available. So this is a pretty extended period of pain. Began in 2008, 2009, and really didn't reach that 5% level for 7 years. Okay, and I'm sure everybody knows what this was, right? This pandemic. So huge sudden increase, far more sudden than either of the other previous recessions, but a huge increase in people who are unemployed because of lockdowns. When people weren't traveling or going out of their houses, some businesses like restaurants, even if there hadn't been lockdowns, if there isn't demand for those things, then they're going to be unemployed and putting people onto furlough. Do you have a question?
Yeah, why is it that the rate went back down so quickly?
Well, because when the lockdowns were over, people went back to work. Yeah.
I just know that, sorry, I just know that because a lot of businesses closed, I just figured it would continue to stay high for a while.
Well, there were some federal programs that basically just gave companies free money to not go bankrupt and to continue paying some of their employees at least maybe partial wages during the lockdown. So you're right, there were a lot of companies that did go out of business, but the ones that went out of business in some cases were replaced by, you know, if one organization was stressed and they went bankrupt, that sometimes doesn't necessarily mean that all the equipment is destroyed and the people still have the knowledge, and so a new business can be reorganized relatively quickly. Yeah, so not every bankruptcy means that the company is dissolved. Sometimes a bankruptcy is just a reorganization. So that's why I think it was able to recover so much more quickly.
Do they count like disabled people as part of the unemployed section, or like and retired people, or how does that work?
No, it's only people who are actively seeking work. Yeah, so people who aren't in the market are not included. And sometimes people argue that that definition, like that you have to actively be seeking employment, is a little bit too narrow because there might be people who are just discouraged, where they want to work and they are unemployed, but they've given up on seeking work because they feel discouraged. So some people say that the way it's measured actually understates how many people are unemployed. And there's this phrase underemployed as well, where somebody may have a job working 25 hours a week, but that's not enough for them to actually make ends meet or to be benefits eligible. So I think there's a pretty good argument to be made that the unemployment rate that's reported here, that the situation sometimes is actually even worse because of those people who are excluded from being counted. All right, so that was unemployment. This figure has two trends on it. One is in blue, the consumer price index, and so that's inflation. Blue is the rate that prices are increasing, and this is, I believe that this consumer price index includes fuel. And so fuel adds some additional volatility to inflation. Sometimes you'll see inflation data that says inflation except for fuel. And that maybe makes the curve a little bit smoother when you take the volatility of gasoline and so on into account. And then the green line is the federal funds effective rate. And so that's the tool that they use to control inflation, or at least try to. And so if you look, our current period of high inflation during the last couple of years, I mean, it was way higher than it was in the decades before that. But in the 1970s and 1980s, inflation was a much bigger problem and for a lot longer than it has been recently. And so there was an economist who is, I think, the chair of the Federal Reserve named Paul Volcker. And he's credited with having finally tamed inflation because he had the tenacity and the ruthlessness to do what nobody else before him was willing to do, and that was to raise interest rates super high. So you'll notice that the two lines seem to be correlated, and that's because the green line can be controlled by people. The blue line is dictated by the economy. So we don't have direct control over the blue line, but the thinking is that if inflation is high, what you can do is you can raise interest rates, and then that slows down economic growth. You're actually on purpose trying to not cause a recession, but you're trying to choke growth a little bit. And when you choke the growth, there will be less demand for products, and it will reduce the rate of inflation. So Paul Volcker in the 1980s, he raised the interest rate really high, and at the time people were complaining. People who borrowed money hated Paul Volcker. Businesses hated Paul Volcker. But in the end, that worked, and it brought the inflation down after more than a decade of kind of being out of control, and then it stayed below 5% for years and years until just recently. So what the Federal Reserve is aiming for is 2% inflation. They consider that price stability, where prices are increasing at a high enough rate that you have some incentive to spend your money, but it's not so quick that prices are going to get out ahead of cost of living adjustments too quickly. So it's kind of an impressive thing that they're able to control so much of the economy with so few tools available, because really all the Federal Reserve can do is raise and lower the federal funds rate. But with that, they're able to, for the most part, have a pretty good impact on inflation and the price increases that we experience. So we're going to continue talking about inflation today. But before we do, I thought I'd just take a detour into describing the dangers of deflation. And if we look back over the data, there's only been deflation just very briefly after the housing bubble. But of course, if we looked back at that figure from the entire history of the United States, deflation was a lot more common prior to the modern era. Since World War II, there were these periods of deflation. So let's talk about why they go to so much trouble to prevent deflation. Deflation is defined as a decrease in prices. So what you can think of is that your money is actually becoming more valuable over time rather than less valuable. In the class on Wednesday, I introduced the phrase purchasing power, where we were talking about baskets of goods and how, in the future, it's likely that $20 is going to buy you less stuff than it gets you now. In deflation, $20 will get you more things in the future. Now, there are a handful of products that actually become cheaper over time, and we just kind of get accustomed to computers getting cheaper over time. If you think about what you can buy, like the amount of processing power and the quality of the machine, computers are a lot less than they used to be. But that's the exception. You can have one or two items that are deflating in price and still have overall inflation. But when the economy as a whole is deflating, it's really dangerous because of the incentives. And so to walk you through, like, what's the mindset of somebody during a deflationary environment, there's this deflationary spiral. Some people call it a doom loop. Because what happens is, think about if you knew in a year something was going to be cheaper than it is now, a certain percentage of people who are going to wait to buy it in the future. If you have to buy it now, maybe you would, but there will be some people who put off the purchase. And the cheaper it will be in the future, maybe the greater the share is of people who are going to put off the purchase. So that falling demand causes prices to go down. And so who can speculate on why is it that there would be a relationship between falling demand and falling prices?
Because if you lower the price, then you don't have to have as much demand for somebody to buy something.
There's a higher supply than there's demand.
What's that?
There's a higher supply than there's demand.
So if there's falling demand, then that means suddenly you've got extra supply. And remember when we were talking about the price-demand relationship, what we said is that the way that you increase demand is by lowering prices. And so when retailers and people who manufacture have an environment of falling demand, they've got all this stuff filling up the warehouse. They're still producing, but now there isn't as much demand, so the only thing they can do is reduce their prices. Or you could think of it from the perspective of the market, that if there's all this extra inventory because demand is less than it used to be, then there are going to be fewer people willing to pay the high price than previously. Some of the people who are willing to pay the higher cost are no longer in the market to purchase the item. So the margin, which is the last person who's going to buy something, kind of controls the price. If that last person in line to buy something isn't willing to think of it as an auction, if there are fewer people in the auction, then the price doesn't get as high. So when demand is going down, so does the price. And then when prices are lower, there are going to be more companies that can't cover their costs. Remember we were talking about the curve of, there's the curve of revenue versus demand. So there's demand, and then there's money on the vertical axis. And there is costs, which includes the fixed cost and the variable costs. And so if demand is going down and people have to kind of boost demand by lowering their prices, then they're going to be receiving less revenue than before. So if you've got less revenue but your costs are more or less the same, in the short term at least, the costs are the same, then more people are going to be defaulting on debts. They're not receiving enough revenue to pay off the equipment that they've borrowed money for. So if they default and go through bankruptcy, then there could be reorganizations or layoffs that brings down the number of people who have money in their pocket, and then that also contributes to demand. So now demand is going down for two reasons. It's going down because there are fewer people who have money, and the people who do have money also know that if they put off their purchase, then they're going to have lower prices in the future. And then this just keeps going around and around. So the deflationary spiral is really dangerous. And so the Federal Reserve is far more afraid of deflation than they are of inflation that's a little bit too high. So that's another reason why they aim for 2% inflation rather than like 1 or 0% inflation, because 0% inflation and 1% inflation is too close to deflation, and deflation is really dangerous. So they'd rather be high than low. So that kind of explains a little bit about the deflationary spiral and the risks that it can cause. And just have to kind of think through what causes the falling demand. Why would prices go down if demand is lower? What's causing the debt defaults, which is you're selling less product at a lower price, but your costs haven't gone down accordingly. That's going to cause bankruptcies, not just of the company that was originally doing the manufacturing, but think about how banks would become stressed, or organizations that had money in banks that are now gone bankrupt, or investors who, the value of their stocks and their asset portfolio is going down, and so they have less money in their pockets, just right along with the people who are working and laid off. Investors don't feel as rich as they were before, even if they haven't lost their job, even if they still have millions of dollars, they've got less than they had before, and that can reduce their demand for luxury goods or even for things like travel and vehicles. And so this deflationary spiral is pretty dangerous. Okay, just a couple more graphs before we get into the in-class exercise for today. This is showing historically how the savings rates have been pretty low, although back in the 80s when they were going through that period of whipping inflation, savings rates were, the amount that you could earn on CDs and savings accounts was high, and it's high again now. But this is a graph here of the market interest rate, I sub F. And I introduced this equation to you last time, and I think it's important to come back and revisit what each of the terms means. So F, remember, is inflation expressed on a percentage basis. So that's the percentage per year. I sub F, the market interest rate, is just what you could actually get from a bank or the return that you're earning on an investment. And then I represents the real rate of return. So that's I is related to your increase in purchasing power. So this graph is showing the real interest rate over time. So it's been negative since about 2010, the real rate of return. When you put money into a bank account that earns less than the inflation rate, you're actually losing money by keeping it in the bank. You're losing purchasing power. Even if the number of dollars you have is increasing, the rate of increase in prices is higher, so your purchasing power is less. And we finally come out of that period of low interest rates, and now the real rates of return on things like money markets and CDs is back into positive territory. So banks call, do you have a question?
You keep bringing up CDs, but like, I don't recall you explaining what a CD, because I assume you're not talking music.
No. Thanks for that question. A CD is a certificate of deposit. And when you put money into a savings account, you can take it out whenever you want. But when you put money into a certificate of deposit, you're promising in advance how long you're going to keep it there. So if you look at what this is saying, there's 6-month CD, 1-year CD. There's just a certain period of time that you agree in advance. And if you take the money out early, then they typically penalize you by withholding a certain amount of interest. So for example, I've got a CD, and if I withdraw my money early, they'll take 3 months of interest. So it kind of discourages you from taking the money out, and they can put the money to better use if they know that it's locked up for a certain period of time, that they don't have to have as much of it in the bank ready to give back to people at a moment's notice. And so a certificate of deposit will usually have a higher rate of return to the investor or depositor than just a normal savings account would. 5 years is pretty typical. Let's see. Oh, the optimal? That varies based on your preferences. So, yeah, it looks like 5 years is pretty typical for being the longest, and there are fixed deposit durations longer than that, but they're not made available from banks. If you want like a really long-term deposit, you can get a bond from the Treasury. So there's Treasury bills are a year and less. Treasury notes are from a year to, I think, 5 years. And Treasury bonds are from 5 years up to as long as 30 years. So you can buy really long-term securities that have a defined rate of return during that period. The difference being that CDs don't have as much liquidity, like you can't trade them on the secondary market as easily as you can trade bonds on the secondary market. But like you wouldn't want to buy a 5-year bond a 5-year CD if you needed that money in a year to pay for like a down payment on a house. But if you have a 12-year-old kid and you want to put money into some sort of an account so it's ready when they go to college, then maybe a 5-year CD would be a good potential investment. So you just have to think about how long you want to lock the money up. And oftentimes, the longer you're willing to lock it up, the rate will be higher. Things are a little bit turbulent right now. Like you'll see the 1-year rate is 5.65%. If we switch it over to 5 years, I don't think that we'll find rates are quite that high for a 5-year CD. I don't know how to get this to actually trigger.
How safe are these? Like, what are the chances of not being any of them?
The $250,000 is insured by the FDIC, which is the federal government. So they're considered pretty safe. And it's $250,000 per depositor. So you could, if you had a lot of money, have one CD in your name, one CD in your wife's name, and one joint CD that has both of your names. And so you could have $750,000 at the same institution. And then if you put more money in a different bank, then that would be insured as well. So CDs are pretty safe. You're not going to lose your money with CDs.
Is that a common practice, like to allow people to do that? I've never heard of that.
Heard of what? Yeah, it's pretty common. Yeah. But right now, just normal money market accounts are paying almost as much as CDs. So maybe in a moment I'll log in and show you on Charles Schwab. You can see what's the current rates for CDs that they're called brokered CDs, where rather than having to open an account with a bank every time you buy a CD, you can just have a broker who goes and does all the paperwork for you, and then you still get a pretty high rate of return. And the nice thing about that is you can just see what is the available interest rate that's being paid for a lot of different durations. So when I pause it and get you started on the in-class exercise, maybe I'll pull that up to show you what it looks like. So banks pay the market interest rate, and if that market interest rate that you're earning is more than inflation, that means your purchasing power is increasing and the I is positive. But you can have a negative rate of return. So I can be negative, and you'll see that in the in-class exercise today, that if the market interest rate is below inflation, then by definition the rate of return for the real rate of return is negative. And banks don't quote real interest rates because they can't predict what's going to happen to inflation. So when you're dealing with future worth, there's two ways to account for inflation when you're doing economic analysis. And one is to take all of the future amounts that you're going to earn and convert it into constant value dollars, meaning all of the expenses that you're going to experience in the future and all of the revenue that you expect to earn in the future, you discount using the inflation rate, and then you'd use the real interest rate in calculating the future value if you wanted to know how much your purchasing power would be going up over time. The other approach to that is to use the future amounts in their inflated values and then use the inflation adjusted interest rate. And this is part two, is what we've been doing so far, is when we've been like calculating the rate of return on a cash flow diagram, we've been calculating the inflation adjusted interest rate, so that if you wanted to know what was the real interest rate out of that, you'd have to define F. So what we've normally been doing is this second way, where we're just combining the effect of inflation and increases in purchasing power into the same factor. Capital recovery, remember, is where you're just trying to figure out how much you would need to earn each year to cover the cost of the equipment that you've acquired. So it's the difference between the initial purchase price and the salvage value, and then you're annualizing it by finding an annual recurring payment amount. So the way to handle capital recovery when it comes to inflation is, remember that the money that you're spending today to purchase the equipment is more valuable than the dollars you'll be recovering in the future because of price inflation. And so if you use the market interest rate, I sub F, that's going to include the inflation rate. So if you want to know what interest rate is desired, you have to kind of separate the two using this formula. So that's what the in-class exercise today is asking you to do, is separate the effect of inflation from the increase in purchasing power that you're hoping to achieve when you're given some market interest rate, such as 1.25% for the first problem. So let me hand this out to you. Okay, I got the solution to the first one up on the screen. Any questions on the first problem? So obviously plugging numbers into the equation isn't the hard part. The hard part is understanding the concept and interpreting the statement to know what you're solving for. So the accumulated amount of funds is going to be dependent on the interest rate that you're actually earning, and that's I sub F. The present value of that accumulated amount tells us that we have to discount it at the inflation rate. So we want to know, how much is that money worth in today's terms? So that's why we're discounting at the inflation rate, to know the present worth of that amount of dollars. The real interest rate is I, where we're given I sub F, we're given F, we can solve for I. So this had a negative real rate of return, and that's why the present value of the amount is less than we actually put into the account. So you put $110,000 into the account, and if the amount of dollars is growing slower than the inflation rate, then you can see that your money is worth less in the future than what you put in. So that's a bad situation to be in. You're not maintaining your purchasing power in this first example. Okay, the second one related to capital recovery. You've got this crane. You want to know how much revenue you have to earn each year. Let me bring the solution on the screen for that. So it's important that when you're trying to calculate an amount to the nearest penny, that you preserve all of the precision in your calculator, that you not round off early. So, I mean, I'm showing this intermediate step here, like the ratio, but I actually had more digits of accuracy in the calculator than are shown here. And so don't get in the habit of rounding off, like, don't call this 15%, because if you round off to 15%, then your final answer would only be accurate to 2 digits. Any questions on the capital recovery question? Yeah.
On the homework, there's a problem like this, you want us to solve it by hand or by Excel work?
Either one. If it doesn't say what you need to do, then you can choose. Be sure and annotate your file, though. Okay, so homework 11 is due on Monday. The project, Friday the 17th. That's it for today. I'll see you on Monday.